Look at this map. Let's start with what Hormuz actually is. It is the narrow body of water connecting the Persian Gulf to the Arabian Sea, lying between Iran on the north and Oman on the south. At its narrowest point, it is just 33 kilometers across, and the inbound and outbound shipping lanes inside that are only about 3 kilometers wide each. Every supertanker leaving Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, Qatar, Bahrain, and Iran has to thread itself through that one needle. There is no other route. So where does all this oil actually go? It does not go to Europe. It does not go to the United States. Look at this map, and the answer becomes obvious. Asia takes around 89% of every barrel that exits Hormuz. According to the EIA's data for the first half of 2025, just 4 Asian countries absorbed 3/4 of all that crude. China is by far the biggest single buyer, claiming 37.7% of total flows. That is more than 5.5 million barrels a day going to a single country. India is second at 14.7%. South Korea takes 12%. Japan takes 10.9%. Add those 4 together, and you get 75% of an oil river that the world economy literally cannot run without. Europe, by comparison, takes barely over 10% of Hormuz crude. The United States, now a net oil exporter thanks to shale, imports almost none of it. Latin America, Africa, and Oceania, basically nothing. For all the noise the Strait of Hormuz generates in Washington and Brussels and London, this is fundamentally an Asia story. Western politicians worry about it because they worry about global price spillovers and recession risk in their own economies. But when policymakers in Tokyo or Seoul or New Delhi or Beijing wake up in the morning and check the news from the Gulf, the consequences are not abstract. It is rationing. It is whether the factory runs tomorrow. It is whether trucks roll on Monday. That is the part most Western coverage misses, and it is why the rest of this video focuses on these 4 economies, because they are the 4 whose entire industrial future is most tightly bound to whether or not Iranian and Omani waters stay calm. Now zoom in on the biggest buyer. According to EIA data for the first quarter of 2025, China alone consumed 37.7% of all the crude flowing out of Hormuz. That is more than India, Japan, and South Korea combined. In raw numbers, somewhere between 5.5 and 6 million barrels a day of Chinese oil rides through that one strait. Roughly half of all the crude China imports. And China is the largest crude importer on the planet. Depends on this single waterway. This is not because Beijing wants to be exposed. It is because the alternatives are still small. Russia's Power of Siberia pipeline and the ESPO pipeline into Daching together now move around 1.7 to 1.8 million barrels a day. Kazakhstan adds a few 100,000 more. Pipeline crude from Myanmar adds a bit on top. But the Middle East still supplies more than half of all Chinese crude, and almost all of those Middle Eastern barrels physically have to pass through Hormuz. This is why China has been quietly doing 2 things at once. First, building strategic petroleum reserves on an enormous scale. By 2025, China's combined commercial and state oil reserves were estimated at over 1.1 billion barrels, enough for around 90 days of imports, on paper. Second, building the world's largest refining base. Chinese refiners can now process roughly 18 million barrels of crude every day, almost 20% of global refining capacity. Both are insurance policies, but the basic exposure does not go away. Cut Hormuz off for a month, and even with the SPR, China's industrial machine would start running into hard limits. Diesel shortages for trucking, jet fuel rationing, petrochemical plants throttled back, fertilizer production slowed at the worst possible time of year. That is why every time tension rises in the Gulf, you can find Chinese Navy and Coast Guard vessels quietly escorting tankers home. India's situation is, in some ways, even more fragile than China's. India imports about 85% of the crude oil it consumes, one of the highest dependency ratios of any major economy on Earth. After Russia invaded Ukraine in 2022, Indian refiners pivoted hard to discounted Russian oil, and at the peak Russia briefly became India's single largest supplier. But that math has shifted. By 2025, Middle Eastern producers, Saudi Arabia, Iraq, the United Arab Emirates, Kuwait, had recovered to supply roughly 45% of India's crude. And almost every barrel of those Middle Eastern imports comes through Hormuz. In total, India took 14.7% of all Hormuz crude flows in early 2025, the second largest single destination on the planet. In raw numbers, we are talking somewhere around 2.2 to 2.3 million barrels a day. To put that in perspective, that is more oil than France and Germany consume combined. What makes India unusually fragile is its diesel addiction. India runs on diesel. Trucks moving goods on the national highways, irrigation pumps in the fields, generators backing up every mid-sized factory and hospital, the railway network's diesel locomotives, and the small construction equipment that builds India's roads. Almost all of it runs on diesel refined from Middle Eastern crude. The country does have a strategic petroleum reserve, but it is small by global standards. Only around 10 to 12 days of imports, far less than China's or Japan's. India has been racing to electrify, building out solar at record pace. It is now the world's third largest solar market, and electrifying its railways. But oil still drove about 35% of India's primary energy use in 2025. A Hormuz disruption would mean an immediate diesel price shock that ripples straight into food costs, freight rates, and ultimately the rupee. The Reserve Bank of India has explicitly modeled Hormuz scenarios in its inflation projections, and the results are not pretty. If China and India are exposed, Japan and South Korea are something closer to trapped. Japan has almost no domestic oil. Around 90 to 95% of its crude comes from the Middle East, and according to the IEA, somewhere between 70 and 74% of all Japanese crude imports physically pass through the Strait of Hormuz. South Korea is in nearly the same position. Roughly 70% of South Korean crude oil and around 18% of its LNG transit the strait. Now look at the chart on screen. We are comparing each country by the share of its own crude imports that depends on Hormuz. Japan sits at the top, around 74%. South Korea, about 70. China, around 50. India, around 45. Per capita, no one on Earth is more exposed to Hormuz than the Japanese and the Koreans. And unlike China, Japan and Korea have no pipeline alternatives, none at all. They are island and peninsular economies. Every barrel of oil has to arrive by ship. Their strategic reserves are large by international standards. Japan holds around 150 days of imports between government and commercial stocks, South Korea about 100 days. But reserves of that size were designed for a temporary shock of a few weeks, not a multi-month closure. A serious Hormuz disruption would force what energy planners politely call demand destruction. Actual rationing at the pump, idled refineries, factory shutdowns, electricity cuts to industry. The Bank of Japan has run scenarios where a 50% disruption in Hormuz flow pushes Japanese headline inflation back above 4% within a quarter. That, in turn, would force the BOJ to abandon its careful path back to normal interest rates and probably crash the yen on top of everything else. It is one of the most underappreciated geopolitical facts of the modern era. Two of the wealthiest and most technologically advanced societies in the world are utterly dependent on the goodwill of Iran not to shut a strait. It is not only oil. The other story Hormuz hides is gas. In 2025, just over 110 billion cubic meters of liquefied natural gas passed through the strait, close to 20% of all the LNG traded globally that year. Almost all of it comes from a single source: Qatar, the world's second largest LNG exporter after the United States. Around 93% of Qatar's LNG output has only one way out, and that way is Hormuz. The destinations look familiar. China, India, and South Korea together absorbed 52% of all Hormuz LNG in 2024, and the share looked similar through 2025. For China, LNG plays a quietly enormous role in the winter heating mix for northern cities, from Beijing up through Tianjin and into the Rust Belt. For India, LNG is the swing fuel for fertilizer plants and a growing share of peaking power generation. For South Korea, it is nearly a fifth of the country's total electricity generation. In a Hormuz disruption scenario, the gas market reacts even faster than oil. There are fewer alternative suppliers in the short term, and LNG cargoes are smaller and more visible than crude flows. The European spot benchmark for LNG, the TTF price, has historically spiked 30 to 50% within days on serious Hormuz scares. Asian buyers, who mostly pay a Brent-linked formula in their long-term contracts, end up importing that volatility directly into their electricity bills and into their fertilizer industry, and from there into food prices for hundreds of millions of people. Add it all up, and Hormuz is not just an oil problem. It is the single most concentrated energy choke point in human history. Roughly a third of seaborne crude, a fifth of global LNG, and the energy security of more than 3 billion people in Asia all depend on one stretch of water you could swim across in about an hour. Which brings us to this week. On June 12, 2026, U.S. forces shot down 2 Iranian drones near the Strait of Hormuz after Iranian boats opened fire on a tanker that tried to transit without permission. Within the same news cycle, Donald Trump announced he had reached what he called a great settlement with Iran, though Iranian officials publicly denied any final deal had been signed. Brent crude, which had been trading above $92 a barrel that morning, dropped back to around 88 to 90 by the close. Markets, for now, are betting on de-escalation. But under the surface, the damage is already done. The European Central Bank just raised its policy rate by 25 basis points to 2.25%, the first ECB hike in nearly 3 years, citing the Hormuz-driven energy shock, pushing Eurozone inflation back above target. U.S. producer prices jumped to 6.5% year-on-year. Gold surged to roughly $4,216 an ounce, up almost 3% in a single day on safe haven flows. Asian stock markets, including Vietnam's VN Index, fell to 12-month liquidity lows. Money is sitting on the sidelines waiting to see whether the strait actually closes. This is the new pattern, and it is the part everyone needs to understand. Hormuz no longer needs to fully shut to cause real damage. The mere threat, a drone here, a tanker boarded there, is enough to shave a few percentage points off global growth, push central banks back into hawkish mode, and reprice every major asset on Earth. And the country it hurts most is not the United States, which is now a net oil exporter. It is not even Europe. It is the Asian giants whose entire economic model, Chinese factories, Indian trucking, Japanese cars, Korean petrochemicals, depends on a steady stream of barrels through that 33-kilometer gap. Until that dependency changes, every Iranian drone is also, indirectly, an Asian problem. If you want more deep dives into Asia's hidden economic levers, the choke points, the supply chains, the data behind the headlines, subscribe. New video tomorrow.